Bank of America is an absolute giant, one of the biggest financial players on the planet. But here's the real question. Is it a good investment? So today, we're going to put it under the microscope using a framework made famous by the one and only Warren Buffett. Let's get into it.
Yeah, when you look at Bank of America from the outside, it looks like this impenetrable fortress, right? But is it really? That's what we're here to find out. We're going to peel back the layers, get past all the shiny headlines, and ask one simple, crucial question. Is that fortress really as strong as it looks?
Okay, so how are we going to figure that out? Well, we're using something called the Buffett litmus test. It's basically his way of checking out a company's long-term durability, and it all comes down to one really powerful idea. And that big idea? It's the economic moat. Now, what is that? Just think of an actual castle moat, the water that protects it from invaders. In the business world, it's pretty much the same thing. It's some kind of durable competitive advantage that keeps the competition out and protects those long-term profits. So, the big question is, does Bank of America have one? Let's find out.
All right, first things first, let's look at the bull case, the good stuff. This is the powerful story the bank tells about itself, using its own official reports and the most impressive numbers it can find. Think of this as the view you get from the top of those fortress walls.
And wow, the first thing that hits you is just the sheer scale of this operation. I mean, Bank of America serves a staggering 67 million clients. They've got thousands of retail centers. This huge footprint, it's really the bedrock of its power and influence. It's incredibly hard to compete with that kind of reach.
Okay, now let's talk numbers, because the story they tell is pretty interesting. So in a recent quarter, you got revenue up 7% year over year. Net interest income, which is a super important number for banks, is up 9%. And get this, earnings per share jumped an incredible 25%. On the surface, come on, that looks like a company in fantastic health, right?
But their strength isn't just about old school banking. Take a look at this number, 42 million. What on earth could that represent? Well, that is 42 million active users for their AI assistant, Erica. And you got to understand, this isn't just some little side project. It is core to their strategy. Erica has handled over 3.2 billion client interactions. That's a huge sign of their investment and, frankly, their dominance in the digital banking space. So let's recap. We've got a massive customer base, amazing-looking earnings, and they're a leader in AI. That economic moat we talked about, it seems pretty wide and deep, doesn't it? Well, that's the view from the outside. The moment you start digging just a little deeper into the numbers, you start to find a few cracks in that fortress. And this brings us to a really critical question. Growth is great and all, but is the bank actually creating real, sustainable value for its shareholders, the people who actually own the company? And this is where the story takes a pretty dramatic turn. What we're looking at here are two absolutely crucial numbers. On the left, that's the return the bank is getting on its investments. And on the right, that's what it costs the bank to get that money in the first place. And as you can see, there is a massive gap. They're paying over 14% for their capital, but they're only making a 3.4% return with it. That's not good.
Yeah, in the investing world, this is what we call a major red flag. The bottom line is really simple. When it costs you more to get money than you make from using it, you are not creating value. You're actually destroying it. But believe it or not, that whole value destruction thing, that's just the beginning. There's a much bigger, much more specific problem hiding on the bank's balance sheet. It's a number so big, it really deserves its own moment in the spotlight. $96 billion. Just let that number sink in for a second. This single figure represents maybe the biggest risk factor that we found in this entire analysis.
So what is it? What's the deal with this $96 billion? It's the unrealized loss sitting on the bank's huge portfolio of bonds. See, they bought all these bonds back when interest rates were super low. Now that rates are way up, those bonds are worth a lot less. And this isn't just some abstract paper loss. This is the largest loss of its kind for any U.S. bank. And get this, it's equal to about 40% of the bank's entire equity. This right here, this is the smoking gun.
And the hits just keep on coming. The concerning numbers don't stop there. Take a look at this one, negative 0.26. On its own, that probably means nothing to you. But in context, it's actually pretty alarming. So this number is the bank's Altman Z-score. It's a formula that's been used for decades to predict how likely a company is to go bankrupt. Now, any score below 1.8 puts a company in what's called the distress zone. So for a titan like Bank of America to have a negative score, that is highly, highly unusual, and it points to a very real risk of financial instability. Okay, let's take a breath. We have two completely different stories here, don't we? On one hand, you've got this growing tech-savvy giant, but on the other hand, you've got a bank that's destroying value and has a huge hole on its balance sheet. So, what's the final verdict? What happened to that economic moat? Well, this SWOT analysis kind of brings it all together. The strengths are obvious, right? Huge market position, a leader in AI. But the weaknesses are just as severe, that value-destroying return on capital, and of course those massive unrealized bond losses. And yeah, sure, there are opportunities for growth in places like wealth management, but the threats from those smaller, faster fintech rivals, they are absolutely real. And all of this brings us to a really sharp, really clear conclusion from the analysis. When you weigh all the evidence, the verdict is pretty stark. The bank's weaknesses have pretty much erased its competitive advantage. That moat, it's no longer protecting the castle. So, after all that, what's the final grade? A C+. You know, for a company with the size and reputation of Bank of America, a C+ is a pretty damning grade. It's a stark reminder of the huge risks that are hiding just beneath the surface of those flashy headline numbers. And this all leaves us with a much bigger question to chew on. The story of Bank of America really shows that even the biggest, strongest-looking financial fortresses can develop some serious cracks. It really makes you wonder, in this new era of AI and nimble fintech companies, can any traditional bank's moat truly be considered permanent anymore? Now that's something to think about.